Imagine taking out a 30-year mortgage to buy a smartphone.
Right, which sounds completely nuts.
Yeah, totally nuts. You sign the papers, you take the device, and you know for an absolute fact that in like 24 months, that phone is just going to be a technologically obsolete paperweight.
A very expensive paperweight.
Exactly. Now, imagine doing that not just once, but literally billions of times over, and you're using other people's money to do it. Today, we're looking at a company doing exactly that. And the wild part is they're calling it the most revolutionary business model of the decade.
It really is a stunning dynamic to watch unfold. I mean, when the broader market looks at a hypergrowth tech company, they usually want to see a skyscraper, right?
Yeah, something solid.
Exactly. They want to see a deep foundation, inspected steel, architects who can literally point to a blueprint and prove the structure will stand for a century.
But that's not what we're dealing with here.
Not at all. In the world of artificial intelligence infrastructure right now, the blueprints are frankly drawn on napkins. And the steel is rented.
Yeah. So welcome to a very specialized, highly forensic deep dive. We are asking you, the listener, to step into some very specific shoes today. You are a public market investor.
And you are not looking for the next rocket ship to ride to the moon.
Exactly. You are actively seeking a high-conviction short candidate. You're looking for a business whose fundamentals are just fundamentally broken, totally regardless of the hype. And the target under our microscope today is CoreWeave.
And to set the baseline for our analysis here, we need to be incredibly clear about our methodology. We are constructing a rigorous, intellectually honest investment thesis.
Which
means we are focusing exclusively on the actual mechanics of the business. We're looking at unit economics, competitive moats, governance, capital allocation, and structural industry tailwinds.
Let me just jump in there and explicitly state the ground rules for you listening. We are entirely 100% ignoring CoreWeave's valuation today.
Completely irrelevant for this.
Right. We do not care about the stock price. Whether the stock is trading at $10, $100, or $10,000, it doesn't matter to this conversation. We are purely performing an autopsy on the structural integrity of the business itself.
And part of that autopsy requires a really strict mandate for intellectual honesty. Because management has a narrative, obviously, and it's a very rosy one.
Oh, they always do.
Always. But we will look past that spin. At the same time, we're not going to manufacture a bear case if the data doesn't actually back it up. Like, if we find that their unit economics are secretly healthy or their competitive moat is impenetrable, we will explicitly say so.
Because the goal is to weigh the evidence and deliver a final verdict on whether this business truly merits a short position over a, say, 5 to 10-year horizon.
Right.
Look, setting up the bull case is easy, right? I mean, CoreWeave is the fastest cloud provider in history to reach $5 billion in annual revenue. They have a massive $66.8 billion revenue backlog.
It's a huge number.
Massive. If I'm a momentum investor, I'm looking at those numbers and I'm practically salivating. The demand for AI compute is unquenchable, and CoreWeave is the one out there selling the water.
Well, that's the narrative that drives the hype cycle. But, in hypergrowth tech, the seeds of destruction are almost always sown during the boom times.
When everyone's getting rich, nobody asks questions.
Exactly. When top-line revenue is growing at these unprecedented rates, it creates this blinding halo effect. Investors just, they stop asking about customer concentration, they ignore the cash burn, they gloss over internal accounting controls.
Which is terrifying.
It is. So our job today is to peel back that $66 billion backlog and look at the actual plumbing of the business.
Yeah, let's start with the plumbing. Because to understand how CoreWeave operates today, we have to look at where they actually came from. They weren't born as an enterprise AI cloud provider.
No, not at all.
They were founded back in 2017 by Michael Intrater, Brian Venturo, and Brandon McBee. And prior to 2022, they were basically just an Ethereum crypto mining operation.
And that origin story, it's not just some quirky piece of trivia, It is foundational to understanding their operational DNA.
How so?
Well, in the early days, they were buying up massive amounts of consumer-grade graphics processing units, GPUs, and just hooking them up to solve cryptographic puzzles to mine Ethereum.
Right, but then the crypto market shifted. Ethereum moved from proof-of-work mining to proof-of-stake in 2022.
Right, the merge.
Yeah, the merge. Basically, the puzzles went away, and mining Ethereum with GPUs became obsolete pretty much overnight.
So CoreWeave found themselves sitting on this massive pile of depreciating hardware with literally no core business model. They had to pivot, or they were going to die.
So around 2020, anticipating this whole shift, they started pivoting to the CoreWeave cloud platform, offering up their hardware for visual effects rendering and, eventually, AI workloads.
And management pitches this as brilliant visionary agility, right?
Yeah.
Like they saw the AI wave coming and repositioned the company perfectly.
But I have to play devil's advocate here. Does a rapid pivot from crypto mining to enterprise AI really show, like, visionary engineering? Or does it just show a purely opportunistic company that happened to own a lot of shovels when a new gold rush started?
It's a great question.
I mean, a GPU is a GPU, right? Why is it so hard to just rent them out to AI researchers instead of mining crypto?
I am so glad you brought that up because a GPU is a GPU fallacy is probably one of the most misunderstood concepts in this entire sector.
Okay, unpack that for me.
Yeah, there's a fundamental structural chasm between running a crypto mining operation and running an enterprise-grade AI cloud infrastructure.
What's the actual mechanical difference? Like, if I have 10,000 GPUs, why can't I just flip the switch and boom, I'm an AI cloud?
Okay, let's look at how crypto mining works. In crypto mining, compute power is entirely fungible and it's highly fault-tolerant, meaning you have thousands of individual rigs just brute forcing math problems independently. If a GPU overheats and fails, it doesn't matter. If the network goes down for 10 minutes, it doesn't really matter. You just reboot the machine.
Okay.
The networking requirements between the individual chips are virtually non-existent because they aren't actually talking to each other. They're just talking to the blockchain.
So it's just a decentralized, messy, brute force operation.
Exactly. Now, contrast that with training a massive large language model for a Fortune 500 company.
Okay.
Enterprise AI requires extreme reliability, fortress-level security, and incredibly complex orchestration software. You aren't just turning on 10,000 GPUs, you are networking them together using highly specialized connections like NVIDIA's InfiniBand so that they act as one single massive supercomputer.
So they all have to stay in perfect sync the entire time.
Precisely. The data has to flow between thousands of chips with zero latency. If one single node fails during a massive training run, it can literally crash the entire operation. Yeah, which means the client has to revert to their last saved checkpoint. And that could cost them millions of dollars in lost compute time. The physical cooling, the networking architecture, the fault tolerance, it is a completely different engineering discipline.
So what you're saying is the DNA required to run a messy, fault-tolerant crypto farm is basically the exact opposite of the DNA required to run a zero-downtime, highly orchestrated enterprise AI cloud.
That is the core issue, and CoreWeave acknowledges this in their own SEC filings. They explicitly state they have a very limited history operating their current business model at scale.
They're trying to build the plane while flying it.
They are attempting to build a highly complex enterprise cloud infrastructure while flying at Mach 5. The legacy cloud providers, Amazon Web Services, Google Cloud, Microsoft Azure, they've spent 2 decades perfecting data center orchestration, network redundancy, and enterprise security. CoreWeave is trying to learn it on the fly.
Let's look at how they are actually monetizing this rapid pivot. Because the revenue model here is fascinating, and I think it hides a massive vulnerability.
It absolutely does.
They generate revenue by selling access to this infrastructure on a per GPU per hour basis. But they aren't really selling it the way Amazon sells cloud space, are they?
No, not at all.
In the first half of 2025, over 98% of CoreWeave's revenue came from what they call committed contracts. These are basically take or pay agreements.
Over 98%. That number should immediately give any investor pause. I mean, it means virtually none of their business is coming from the traditional, flexible, pay-as-you-go model that made cloud computing so revolutionary in the first place.
So explain the mechanics of a take or pay contract to me. Like, if I'm an AI startup, what am I actually signing?
If you're an AI startup and you need guaranteed access to, say, 1,000 NVIDIA H100s for the next 3 years, CoreWeave says, fine, we will reserve them for you, but you are going to sign a contract guaranteeing you will pay for them, whether you actually use the compute hours or not.
Wait, so if my startup's engineers take a month off for the holidays, or our model finishes training early, I'm still on the hook for the hourly rate of those chips.
Yes, you pay regardless. But the trap goes much deeper than just guaranteeing the revenue. The real issue is the prepayments.
Okay, the cash flow side.
Right. These take-or-pay contracts require massive upfront cash infusions from the customers. If we look at 2023 and 2024, the weighted average prepayment across all of CoreWeave's active contracts was between 15% and 25% of the total contract value.
Hold on, so if my startup signs a $100 million contract over 3 years. I have to wire CoreWeave $15 to $25 million in cash today before I have run a single line of code.
That is exactly how it works. CoreWeave is heavily reliant on these massive upfront cash infusions. They are essentially using their customers' cash to go out and buy the physical servers required to service those very same customers.
It's a highly aggressive working capital strategy.
Very aggressive.
But if I'm a bull, I might say, hey, that's brilliant capital efficiency.
Right.
Why use your own equity or debt when your customers are literally willing to front the cash for your capital expenditures? It proves how desperate the market is for their product.
And it is brilliant in a supply-constrained market. Right now, AI compute is the most coveted resource on the planet. Customers are desperate, so they have absolutely no leverage. They're forced to agree to these draconian take-or-pay terms and massive prepayments just to secure capacity.
Right.
But we are looking at this over a 5 to 10-year horizon. What happens to this business model when the power dynamic shifts?
You mean when the ship supply finally catches up to the demand?
Precisely. As the AI market matures and as hyperscalers bring more capacity online globally, the power dynamic will inevitably shift back to the customer.
Makes sense.
When an AI startup can go to AWS or Google Cloud and get compute on a flexible, pay-as-you-go basis without tying up $20 million of their venture capital in a prepayment,
Right.
why would they ever sign a take-or-pay contract with CoreWeave?
So if the industry standard normalizes, CoreWeave's entire upfront cash flow engine just seizes up.
It evaporates overnight. And without those prepayments acting as a financial crutch to fund their hardware purchases, the deep underlying unprofitability of their operations will be fully exposed. They will have to fund their capital expenditures entirely through debt or highly dilutive equity raises.
Wow. Let's talk about the customers who are actually signing these contracts, because this is where the bear case goes from theoretical to just straight up alarming.
Yeah, the customer concentration.
Exactly. Management claims they have a deep competitive moat, and they love pointing to that massive $66.8 billion backlog. But when you look at who actually makes up that backlog, the foundation totally crumbles.
The customer concentration risk here is frankly staggering for a public company of this valuation.
Let's pull the exact numbers from the S1 filing. In the second quarter of 2024, their top 2 customers accounted for 79% of their total revenue.
79%.
Yeah. Now, normally you'd expect a company to diversify as it scales, right? But by the second quarter of 2025, a single customer, Microsoft, accounted for 71% of CoreWeave's revenue.
Just unbelievable. 71%. And no other single customer accounts for more than 10%.
Let that sink in. Nearly 3/4 of a company generating over $5 billion in annualized revenue is entirely dependent on one single entity.
The analogy I use for this is real estate. Imagine you own a massive luxury hotel and business is just booming. You're generating record profits.
Okay.
But then someone looks at your guest registry and realizes that 71% of your rooms are being rented out by one guy. If that one guest decides to check out, you don't just miss your quarterly earnings target. You likely default on the mortgage and lose the entire building.
The hotel analogy is perfect, but the reality for CoreWeave is actually much worse than that.
Why?
Because the guest renting 71% of the rooms isn't just some rich tourist. The guest is the CEO of a competing hotel chain who is temporarily housing his guests in your building while he finishes constructing a mega resort right across the street.
Oh, that is brutal. Let's unpack that, because that is the absolute crux of the issue. Microsoft is not just a standard enterprise customer here.
Microsoft is Azure. They are one of the big 3 hyperscale cloud providers. They are CoreWeave's direct competitor, and they have vastly deeper pockets. So the obvious question is, why on earth is Microsoft renting compute from CoreWeave instead of just building their own AI data centers?
Because building data centers takes physical time. You can't just throw money at a plot of land and have a gigawatt data center magically appear the next day.
Right.
You have to secure environmental permits, negotiate complex power purchase agreements with local utilities, pour concrete, set up cooling infrastructure, wait for supply chain deliveries. Microsoft is pouring tens of billions of dollars into building their own proprietary AI infrastructure to service OpenAI and their enterprise clients.
But they just can't build them fast enough to meet the current demand.
Exactly. Microsoft is facing temporary physical capacity gaps. So to bridge that gap, they are renting capacity from CoreWeave. CoreWeave is essentially acting as a temporary release valve for Microsoft's overflow.
I want to push back on the timeline here, though. If I'm holding CoreWeave stock, I'm arguing that AI demand is growing so incredibly fast that Microsoft will never catch up.
That's the bull argument.
Right. The pie is expanding so rapidly that Microsoft will need to keep renting from CoreWeave in perpetuity just to keep their head above water. Why is that assumption wrong?
Because history in the technology hardware sector tells us exactly how this ends. Look at historical comps. Look at companies like GT Advanced Technologies, which supplied sapphire glass to Apple, or Imagination Technologies, which supplied GPU designs to Apple.
Oh, right.
When a massive tech behemoth makes up the vast majority of your revenue, they completely dictate the terms of your existence. Eventually, the behemoth verticalizes. Microsoft has virtually unlimited access to capital. They will finish their data center build-outs.
And when they do,
Why would Microsoft continue to pay a hefty premium to a middleman like CoreWeave when they can run those exact same workloads on their own fully depreciated hardware inside Azure? The moment Microsoft's internal capacity catches up, that 71% of CoreWeave's revenue could simply vanish.
just gone.
Or at the very least, Microsoft will use the very real threat of leaving to ruthlessly renegotiate the pricing, absolutely crushing CoreWeave's margins.
This completely undermines CoreWeave's central narrative then. Management insists they have this durable competitive differentiation. They say they are purpose-built for AI. Their big selling point is that they have the fastest deployment of the newest NVIDIA chips. They get the Blackwell B200s and the GB300 NVL72s before the legacy cloud providers do, and they get them online faster.
And this is where we have to be really honest and define what a moat actually is. Having the newest hardware first is a temporal advantage. It's a head start. It is absolutely not a structural moat.
Let's define the difference for the listener. What actually makes a true moat in the cloud sector?
A true moat in technology is built on high switching costs, proprietary software ecosystems, or network effects. Think about AWS or Microsoft Azure. Once an enterprise integrates their databases, their security protocols, their Active Directories into the Azure ecosystem, it is incredibly painful, expensive, and risky to migrate to another cloud. The software is sticky.
But CoreWeave isn't selling a sticky software ecosystem. They are literally just renting out commoditized hardware.
Exactly. Amazon, Google, Oracle, Microsoft, they all have infinite access to capital. They can buy the exact same NVIDIA chips. CoreWeave even admits this in their own S1 filing.
Do they really?
Yes. They state explicitly that their competitors have greater financial, technical, and marketing resources and can bundle services at lower prices.
So the speed to market advantage is just a temporary illusion. You might get the newest chips 3 months before AWS does, but AWS has the capital to buy 10 times as many chips eventually, and they can offer them to the customer at a massive discount if the customer also buys AWS storage and networking services.
That is the ultimate vulnerability. If your only competitive advantage is that you have the shiniest new toys first, what happens when everyone else gets those toys? Your pricing power evaporates.
If the moat is really that shallow, and it's entirely dependent on constantly buying the newest chips to stay relevant, we have to look at how much it is actually costing them to stay on this treadmill. Let's look at the fundamental unit economics.
This is where the financial engineering really starts to unravel.
Let's track the trajectory of their revenue versus their net loss, straight from their 2025 annual report.
Okay, let's hear it.
In 2023, they generated $229 million in revenue, and they had a $594 million net loss. Okay, early stage, investing heavily, we get it.
Yeah.
But let's look at 2024. Revenue jumps to $1.9 billion, a massive leap. But the net loss grows to $863 million.
Right.
And then we hit 2025. Revenue explodes to $5.1 billion. But the net loss, it climbs to a staggering $1.2 billion.
Think about the mechanics of operating leverage here. In a healthy software or cloud business, as your revenue scales up 22 times, which is exactly what happened here between 2023 and 2025, your losses should shrink.
Because of fixed costs.
Exactly. Your fixed costs, your corporate overhead, your R&D, they get absorbed by a much larger revenue base. The incremental margins on each new dollar of revenue should be highly profitable.
But here, the net losses have literally doubled as revenue went up 22x. The unit economics are actually deteriorating at scale. It is literally costing them more to deliver the next dollar of revenue than it did the last one.
Exactly. Now, if you listen to management's earnings calls, they will aggressively try to distract you from this reality. In their Q4 2025 presentation, they highlighted a 57% adjusted EBITDA margin. They want investors focusing on that one number.
Adjusted EBITDA, the classic earnings before all the bad stuff metric. Let's break down why that is specifically misleading for a company like CoreWeave.
Well, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. For a pure-play software company, adjusted EBITDA can be a somewhat useful metric for operational cash flow, simply because software doesn't physically degrade.
Right. Code is code.
But CoreWeave is not a software company. They are a heavy asset hardware company. The D in EBITDA stands for depreciation.
And their entire business model relies on buying billions of dollars of hardware that rapidly depreciates.
Yes, ignoring depreciation in a capital-intensive hardware business is like analyzing the profitability of an airline while explicitly ignoring the cost of jet fuel and aircraft maintenance.
Yeah.
You are ignoring the single largest cost center of the business.
That's a great analogy.
If you strip away management's adjusted EBITDA spin and look at their GAAP-adjusted net loss margin, which actually accounts for the cost of the hardware degrading it, sits at negative 18%, they're deeply structurally unprofitable.
And to maintain that $5 billion in top-line growth, they can't just stop buying hardware. They are trapped on a capital expenditure treadmill. Just look at the fourth quarter of 2025 alone. Their capital expenditures were $8.2 billion. To fund all of this buying, as of June 2025, they had amassed total indebtedness of $11.2 billion.
Let's take that a step further, because that massive debt burden combined with the nature of the hardware introduces a severe, totally underappreciated risk: obsolescence.
Let's go back to my analogy from the beginning of the deep dive. Taking out a 30-year mortgage to buy a smartphone, they are taking on $11.2 billion in long-term debt to buy NVIDIA GPUs that become technologically obsolete in 2 to 3 years.
Right.
By the time they pay off the first few years of interest on that debt, the chips they bought are practically paperweights in the enterprise AI world, and they have to go take out more debt to buy the next generation of chips.
The mechanics of that depreciation risk are outlined in their SEC filings, and it is terrifying if you read it closely. They have to make accounting estimates on the useful life of these GPUs. They are amortizing the cost of these chips over several years, but what happens if their internal estimates are wrong?
Meaning, what if the pace of innovation accelerates? What if NVIDIA or AMD or a totally new competitor suddenly releases a chip that is 10 times faster, uses half the power, and comes out a year earlier than anyone expected?
That's the nightmare scenario.
Yeah.
If a radically better chip hits the market ahead of schedule, the older generation chips that CoreWeave holds on its balance sheet instantly lose their value. The customers will demand the new chips.
Then CoreWeave is stuck holding the bag.
CoreWeave would face massive accounting write-downs on their existing assets. They would have to take a huge charge against their earnings, which would obliterate their balance sheet and wipe out their equity value. They are running faster and faster on this treadmill, borrowing billions just to stay in the exact same place competitively.
Okay, so let's summarize where we are so far. We have a company with a shallow moat, extreme customer concentration with Microsoft, deteriorating unit economics, and $11.2 billion in debt tied to rapidly depreciating assets.
It's a lot.
If you are operating a business with those kinds of razor-thin margins for error, your execution has to be flawless. You need pristine accounting and ironclad board oversight.
Which brings us to the governance and internal controls of the company. Because instead of pristine oversight, we find a chaotic back office that just cannot be trusted.
When I was reading the S1 filing, this specific section legitimately made me stop and just stare at the wall. They explicitly state they have, and I quote, material weaknesses in internal control over financial reporting.
Yeah.
And it's not just some minor technicality or a late filing. The risk factors explicitly list a lack of IT general controls over financial applications, insufficient segregation of duties across financially relevant functions, and a lack of a sufficient number of qualified personnel within its accounting and finance functions.
If you are a public market short seller, reading that paragraph is literally like striking oil. This isn't a typo in an Excel spreadsheet. A material weakness is a specific regulatory term.
What does it actually mean?
It means the company's internal accounting systems are so fundamentally flawed that management literally cannot guarantee to investors that its financial statements are accurate.
I want to understand how this actually impacts the business.
Yeah.
How does a company generating $5 billion in revenue simply not have enough qualified accountants?
It speaks to a hyper-growth, move fast and break things corporate culture, where the back office was viewed as a cost center and completely neglected. Imagine the reality inside that accounting department right now.
Yeah.
You have billions of dollars in highly complex customer prepayments coming in. You have rapidly depreciating hardware assets that need to be tracked across multiple data centers. You have massive debt covenants to monitor. And you are trying to do this with a skeleton crew of overworked accountants.
Let's give a hypothetical scenario so you can really visualize this.
Yeah.
How does a lack of IT controls and a lack of segregation of duties actually lead to misstated financials?
Okay, let's invent an accountant. Let's call him Bob.
Okay, Bob.
Bob is working at 2 a.m. trying to reconcile a $50 million prepayment from an AI startup. The contract spans 3 years, so Bob has to figure out exactly how much of that $50 million can be recognized as revenue this quarter and how much has to be deferred as a liability.
Right.
Segregation of duties means that Bob should be able to calculate the revenue, but a different senior manager must review and approve the entry before it hits the general ledger.
It's just a basic check and balance.
Exactly. But CoreWeave admits they lack insufficient segregation of duties. That means Bob might be able to calculate the entry, approve the entry, and post the entry all by himself.
Oh boy.
Now add in the lack of IT general controls. This means the accounting software itself might not have the proper security locks. Bob might be managing this $50 million deferred revenue schedule on an unlocked Excel spreadsheet on a shared server.
Meaning anyone could mess it up.
Anyone could accidentally overwrite a cell, change a formula, or alter the depreciation schedule of $1 billion worth of GPUs.
That is a recipe for catastrophic accounting errors. When you combine complex, highly subjective accounting rules with a lack of personnel and weak IT security, you are begging for aggressive revenue recognition or future financial restatements.
It completely undermines the credibility of every single financial metric they report. If they say they have a 57% adjusted EBITDA margin, how can you trust that number if the system calculating it has material weaknesses?
You can't. So the obvious question is, where is the board of directors? Who is supposed to be supervising this chaos? Let's look at the governance structure. The co-founder, Michael Intrater, serves as CEO, president, and chairman of the board.
Concentrating that much power in a single founder is always a corporate governance concern, but it is a massive red flag in a newly public company with explicitly stated accounting weaknesses.
Why is that dual CEO-chairman role so dangerous here? I know they have a lead independent director, Glenn Hutchins, so they aren't totally without outside voices.
Having a lead independent director helps, sure, but when the CEO is also the chairman, he controls the board's agenda. He controls the flow of information to the independent directors.
Right.
He decides what gets discussed at the board meetings and what gets buried in the appendices. It creates a structural dynamic where challenging the CEO or demanding a massive overhaul of the accounting department becomes incredibly difficult for the independent board members.
And we might actually be seeing the fallout of that dynamic already. Look at the executive turnover. Jack Kojan was a longtime director. He had been deeply involved with CoreWeave since the early days. But suddenly in April 2026, right after the company goes public, he notifies the board he will not stand for re-election.
The timing of that departure is critical. You have to ask yourself, why is a veteran board member walking away right at the moment of triumph? The company just went public, they have $5 billion in revenue, and they're in the middle of integrating a massive acquisition.
Fishy.
Sudden departures of experienced directors during complex financial transitions often signal internal discord. Or, more cynically, it often signals a desire by independent directors to limit their personal liability.
Interesting.
If a board member sees storm clouds gathering regarding the internal accounting, the safest move is to quietly step off the board before the storm hits.
Speaking of complex financial transitions, let's look at how this management team operating with unchecked power and weak internal controls is actually allocating the billions of dollars of capital they're raising.
This is perhaps the most alarming aspect of the entire short thesis. When you have a management team heavily incentivized by top-line growth, and they are facing physical constraints like power shortages, they often try to buy their way out of the problem.
And CoreWeave's recent M&A track record is literally a masterclass in value destruction.
It really is.
Let's walk through the Core Scientific buyout saga because the timeline here is truly wild. Let's go back to June 2024. CoreWeave makes an unsolicited offer to buy Core Scientific for $5.75 per share in cash. The Core Scientific board rejects it. They say the offer significantly undervalues the company.
Which, is a standard negotiating tactic.
Right. So you'd expect CoreWeave to maybe bump the offer to like $6.50.
Yeah.
But no, a full year goes by. It's now June 2025. CoreWeave comes back and offers $15 per share in stock.
Big jump.
Huge jump. Finally, in July 2025, they reach an agreement. CoreWeave agrees to exchange 0.1235 shares of its own stock for each share of Core Scientific. Based on the stock prices at the time, that implied a price of $20.40 per share.
Wow.
That is a 65% premium to the unaffected stock price. It valued Core Scientific's equity at $9 billion.
It is a breathtaking example of undisciplined capital allocation.
Let me make sure I have this straight. They literally bid against themselves. It's like you offer a guy $50,000 for a house. He says no. You wait an entire year during which absolutely no one else makes an offer on the house. And then you come back and offer him $200,000. Why on earth would a management team approve that?
Because they were desperate. To understand this deal, you have to look at the relationship between the two companies prior to the acquisition.
Okay.
CoreWeave was already Core Scientific's only high-performance computing hosting customer. Core Scientific was acting as the landlord. They were providing 500 megawatts of power and physical data center infrastructure to house CoreWeave's GPUs.
So CoreWeave essentially bought their own landlord.
Yes, and they bought them at a massive, completely self-inflicted premium.
I'm going to play devil's advocate again here. If I'm CoreWeave management, I'm arguing that securing power is the single biggest bottleneck in the AI industry right now. I need gigawatts of power.
Right, power is everything.
So by acquiring my landlord, I lock in that 500 megawatts permanently. It's vertical integration. I no longer have to pay the landlord's profit margin, and I can use those hard assets to secure cheaper debt financing. Why is that a bad strategy?
The fundamental strategy of securing power is sound. The execution and the price paid are disastrous. From a bearish perspective, this looks like a panicked, reactive move to secure capacity at any cost, using highly inflated CoreWeave stock as currency.
Got it.
If they were already renting the space under long-term contracts, overpaying by 65% just destroys shareholder value. And more importantly, it comes with massive toxic baggage.
The crypto baggage.
Exactly. Let's look at the integration risks. Core Scientific is not a pure-play, state-of-the-art AI data center company. They are a crypto miner. In 2024, 95% of Core Scientific's revenue, almost $486 million, came strictly from crypto mining.
Wait, let's connect the dots here. CoreWeave started as a crypto miner in 2017. They realized the business model was dead, so they pivoted away from it to become an AI cloud provider.
Right.
And now they just spent $9 billion to buy a company where 95% of the revenue comes from the exact same volatile, low-margin crypto mining industry they deliberately abandoned.
You literally cannot make this up. CoreWeave admits in their filings that they have absolutely no strategic interest in mining Bitcoin. They explicitly state they may have to repurpose or divest the crypto business entirely.
Let's assess the probability of this integration actually succeeding. You have a massive culture clash. You're trying to mash together two completely different hardware infrastructures, Bitcoin ASICs versus NVIDIA AI GPUs.
Right.
You were doing this while trying to maintain top-line growth, and you were doing it with an accounting department that already has material weaknesses.
The probability of failure is extraordinarily high. Look at historical comps of massive M&A deals done at the peak of a hype cycle. Think of AOL Time Warner. When you overpay drastically for an asset, you inevitably face massive goodwill impairments.
Let's explain goodwill impairment for the listener, just to be clear.
Sure. When you buy a company for $9 billion, but the actual physical assets, the buildings, the servers, are only worth, say, $3 billion, the remaining $6 billion is recorded on your balance sheet as an intangible asset called goodwill.
Okay.
It represents the premium you paid for the brand, the synergies, the future growth. But if those synergies don't materialize, accounting rules force you to write down the value of that goodwill. You have to admit to the market, we overpaid, and that value is gone.
And if CoreWeave tries to divest the crypto mining assets to focus purely on the data centers, who's going to buy them?
Exactly. They will likely have to sell used crypto rigs at a steep loss, taking a massive hit to their earnings.
And to prove this isn't a one-off mistake, look at their other M&A activity. In May 2025, they acquired an AI developer platform called Weights and Biases. And right there in the S-1 filing, they explicitly warn investors of unanticipated write-offs and goodwill charges associated with the deal.
It establishes a clear, undeniable pattern. This is a management team that is manufacturing growth through serial, overpriced acquisitions rather than executing efficiently internally.
They're buying top-line revenue.
They are buying top-line revenue and physical power constraints, and they are doing it with reckless disregard for unit economics. When a hypergrowth company relies on M&A to mask internal operational deficiencies, it almost always ends in a spectacular collapse for public market shareholders.
Okay, we have covered a massive amount of ground here. We have dissected their pivot from crypto, the fragility of their take-or-pay prepayments, the illusion of their hardware moat, the terrifying reality of their 71% reliance on Microsoft, the material weaknesses in their accounting, and the value-destructive $9 billion core scientific acquisition.
It's a heavy list.
It is. Now, it is time to synthesize all of this into a concrete investment thesis.
We need to look at this business strictly over a 5 to 10-year horizon. We have to look past the current quarter's hype.
Because even if CoreWeave executes their internal plan perfectly, even if Bob the accountant fixes the spreadsheets, and Microsoft stays for another 3 years, and they somehow seamlessly integrate core scientific parties, they are still sailing a fragile ship into a macroeconomic hurricane.
The structural industry headwinds are the final nail in the coffin. The physical reality of AI is catching up to the Silicon Valley hype. Training these massive generative AI models demands unsustainable amounts of power and water. A single hyperscale data center can consume as much electricity as a medium-sized city.
And CoreWeave is out there boasting to investors about a 1.3 gigawatt infrastructure plan.
The filings note increasing regulatory scrutiny regarding energy usage. We are already seeing moratoria on data center development in key tech hubs like Northern Virginia and Ireland.
Because it's too much strain on the grid.
Exactly. Local governments are realizing that data centers strain the public grid, drive up electricity costs for residents, and provide very few local jobs compared to, say, manufacturing plants.
So what happens when a state utility commission simply says no more power for AI?
That is the structural headwind. CoreWeave's entire growth trajectory could be halted by the stroke of a local regulator's pen. They could find themselves in a scenario where they have borrowed billions of dollars, purchased tens of thousands of NVIDIA chips, installed them in racks, but they have absolutely no permitted power to turn them on.
Just sitting in the dark.
The assets would sit idle, depreciating rapidly toward zero, while the $11.2 billion in debt continues to accrue massive interest.
So we arrive at the final question. I am asking you directly to weigh the evidence we have painstakingly laid out today. Does this business truly merit a short position? Or are we just being unnecessarily cynical about a hyper-growth company that is experiencing standard, albeit messy, growing pains?
Well, to maintain complete intellectual honesty, as we mandated at the beginning of the show, we must acknowledge the bullish elements. You simply cannot ignore a $66.8 billion revenue backlog. The top-line revenue growth is undeniably rapid. Right now, in this specific macro environment, the global demand for AI compute is seemingly insatiable. If CoreWeave can somehow outrun their debt maturities, fix their internal accounting systems, retain Microsoft as a captive customer, and flawlessly integrate Core Scientific, the stock could run. However, as an investor seeking a high-conviction short candidate, you are looking for structural fragility. And based on our forensic review, the conclusion must be that a highly credible, high-conviction short thesis absolutely exists. The foundation of this business is cracked in multiple places.
Summarize the bear case thesis for us.
The combination of extreme customer concentration with a direct competitor representing 71% of revenue alongside deep structural unprofitability masked by temporary customer prepayments creates a highly unstable baseline. Add in the explicitly stated material accounting weaknesses, the lack of independent board oversight, and the completely undisciplined capital allocation demonstrated by the $9 billion Core Scientific deal, and you have a toxic corporate cocktail.
Their moat is just an illusion of speed.
Precisely. Their competitive advantage is not built on proprietary, sticky software ecosystems. It is built entirely on being first in line to buy third-party NVIDIA chips. As infinite capital from hyperscalers like AWS, Google, and Azure floods the market, that temporal advantage will vanish.
It has to.
The probability that CoreWeave's current growth initiatives will generate returns below their cost of capital over a 5 to 10-year horizon is extremely high. It is a prime candidate for secular, company-specific value destruction.
It's the skyscraper built on rented land, with uninspected steels sinking into the mud.
It is the ultimate test of narrative versus structural reality in the public markets.
As we wrap up this deep dive, I want to leave you, the listener, with one final provocative thought to mull over on your own. We have spent this entire hour talking about the brute force physical constraints of AI, the billions of dollars of GPUs, the gigawatts of power, the massive data centers. Our entire bear case is predicated on these massive capital expenditures breaking the company.
Which is the current reality of the industry.
But what happens to CoreWeave's entire business model if the AI industry achieves a software breakthrough? Think about the history of computing. Hardware scales until software gets smarter. What if tomorrow, researchers at MIT or OpenAI develop a new algorithm architecture, like a 1-bit LLM that requires only 1/10 of the compute power to train and run the exact same models?
That is the ultimate existential risk.
If the sheer brute force of GPUs is no longer the fundamental bottleneck for AI development, CoreWeave's $66 billion backlog vanishes overnight. Their mountain of depreciating hardware doesn't just lose its premium value, it becomes a multi-billion-dollar anchor of debt that drags the entire ship down to the bottom of the ocean.
It is a phenomenal point. The biggest threat to a company selling shovels is someone inventing a bulldozer.
Thank you for joining us on this forensic deep dive. Remember to look past the top-line spin, always dig into the unit economics, and keep questioning the narrative. We'll see you next time.